evening, everyone. As we gather today in the heart of Texas, a state known for its entrepreneurial spirit and tech innovation, it's only befitting that we talk about how profound an impact technology is having on the world of investing, and even more so now that you have your own stock exchange coming up. Our panelists today have a diverse range of perspectives from the industry. We have Nicole Chambers from Texi. We have Alan from Wealthfront and Scott from Goldman Sachs Private Wealth Management. Thank you so much for being on the panel today. So I was really looking forward to this event, and part of it was because just before the pandemic around 2019, I had a similar set of conversations sitting on panels in Asia, specifically in Singapore, which is aspiring and to some extent has become the center of wealth for Asia. And we were talking about how tech is kind of completely changing the landscape within investing, and we had the stock exchange of Thailand talk about how that is posing new and evolving challenges for stock exchanges as well. So this was my opportunity to basically connect the dots from Asia all the way to the US. I don't know about you guys, like why you are here, what was your hook for the panel or the session, but for me, I thought there were 2 or 3 things that really kind of drew me to fly all the way from San Francisco. One of that being the whole discussion that we had today at the other panels about the changing customer needs and preferences and behaviors. Is that really translating into something as serious as finance and investing? And secondly, how is technology really changing the contours of the industry overall? And of course, some PA advice, which we have our wonderful panelists on for anyways. So let me start with you, Nicole. The number of companies going public for the first time is on this longest cold streak since the 1980s. What is Texi going to do to make going public great again? And what are some of the challenges that you're addressing there?
Sure. I think to put into perspective, just to give you a quick stat, since the mid-90s, we've seen a decrease in public companies by 43%, and on the contrary, internationally, an increase in 35%. So there's certainly something that needs to be addressed, and a really great opportunity for us to reassess the capital markets and bring the Texas Stock Exchange as a third alternative to the current duopoly that's out there. The Texas Stock Exchange is really taking a thoughtful approach to how to consider the business. We want to be part of the ecosystem, not an obstacle in the ecosystem. And, whether that be through incentivized trading or lower regulatory requirements, there's a whole benefit in being early on in this stage. Why I've been brought on the listing side is to talk to companies, canvas companies on the private and public side to understand why and how we can be aligned with their needs as they look at the capital markets or are already in the capital markets.
Okay, so we were talking about some of the changing behaviors and aspirations or even preferences. There are a lot of studies that suggest that some of that is a function of the generation in which you belong. And we promise this is going to be an engaging session, so I want to do an audience poll, and we don't have a tool there, so raise of hands. How many millennials in the room? And the definition is anyone born between 1980 and 1999. Okay, we do have some majority of millennials, so that's great. How about Gen Xers, who were 1965 to 1980? We have Gen Xers in too. That's amazing. And how about Gen Zs? Do we have some Gen Zs in the room? You'll have to be loud. Okay, you have to make up for your entire generation when we are polling now. So to share some data, millennials are increasingly representing a bigger proportion of the world's largest 4 economies, the US, China, Japan, and Germany. Specifically, closer to home in the US, 22% of the population is millennial, and together with Gen Zs, they're about 40% of the entire population. This generation is expected to shape the changing flows or the global investment flows over the next decade, and not just by virtue of entering and being more dominant in the workforce, but also because of the whole generational wealth transfer that we've heard and talked about. And one other aspect that people tend to miss is we always look at them as a consumer class, but what you're forgetting is even within the industry, people working within investments are going to be increasingly millennials and Gen Zs. So the way they look and approach investing is going to see a seismic shift if they are anything different from their parents. So Alan, I know Wealthfront is focused, and you claim to be like a pure play on millennial wealth. So why are millennials special for you? And how do you see their demands as being different from their other generational counterparts?
Well, thank you. So Wealthfront started in Palo Alto and mostly grew up with software engineers during the technology boom. Wealthfront was founded kind of 2010, so kind of in the second decade of 2000s. And millennials are important to us because they grew up very digitally native as they came into wealth accumulation, similar to Gen Z, which is essentially only live with the internet. And so they want that experience of digital first, which the first panel talked a lot when they were referring to their younger customers who want to be digital. And so we only have an app, right, or on the web. There's no branches. As a matter of fact, in terms of our clients who are around 30, 33, and actually have six-figure salaries and really high net worth, they pay us not to talk to us. So like Lauren said, they don't want to talk to people. And so this is a much different shift than, as you mentioned, other generations which want the higher touch. Now, that obviously depends at wealth levels, at higher wealth levels, which Scott probably deals with. People want to have their handheld and that higher touch. But when you're talking about millennials who are just now building that wealth accumulation, they want to interact digitally with their wealth app just like they would if they were ordering off Amazon, hailing an Uber, or ordering DoorDash or something like that.
So one thing definitely rings a bell with me. Like, I think my parents' generation is way less comfortable sharing information on the internet, like giving out their personal details, whereas our generation kind of grew up with the fact and very comfortable interacting and operating online, right? But I think Alan made a point here, Scott, that the behaviors of how we live our life are translating to the investment world. You've been doing private wealth for about 25 years now. Is that about right?
Right.
So you must be seeing that dichotomy of changing and evolving behaviors across the families that you deal with, right? Like, how is that manifesting in the way you are engaging your clients, how you're bringing the families together? What are you seeing from your vantage point?
So there are meaningful changes. I joined in the late 90s, as you said, so I've been at Goldman for 25 years. I did some different things in there, but I joined 25 years ago. And it was primarily a relationship then between the private wealth advisor and generally the matriarch or patriarch who had created the wealth themselves, and they were a first-generation wealth creator, typically. I'm generalizing, obviously. Since then, those original clients and the clients, the Ford family that the business was built around at Goldman Sachs in the late 1950s, additional generations have come into play, obviously. And so as Generation 2 and Generation 3 are brought up, for us, a big part of the interaction has been how do we help families educate their children on living with wealth and how do they get comfortable with it. The primary focus for that really has been around philanthropy, where a family may form a foundation, and as children come up at 16 or 18, some predetermined age, they'll join the board of the foundation. They'll begin to have a share of the foundation allocated to them, and they'll make suggestions, and the rest of the family will vote on it. And it's just been ways to try to get comfortable and help that next generation get comfortable. And for us, it's really important so that those folks will be comfortable working with the same advisors their parents worked for and don't immediately Google Wealthfront as soon as this ends.
It's a very valid point, right? How do you see that translate into the way the industry has changed, right? Like, obviously, as part of global markets, I know that there has been drastic change where that technology has brought about. But how are you seeing that? Is it more evolutionary? Is it more revolutionary?
And that is the way I describe it, right? So since I joined in our business, which again, the core business for private wealth for us is our advisors providing the best advice, whether it's trust and estate planning advice, whether it's tax advice, whether it's around philanthropy, whether it is around educating that next generation, and then investments mixed in there too. That's ultimately what we get paid for, providing Goldman's best advice in a high-touch fashion to ultra-high net worth families. That's what we do. And at its core, that really hasn't changed all that much in the 25 years that I've been there, and that's the phrase I used. I describe that change as evolutionary, not revolutionary, right? There are technologies that have made things more efficient. The account opening process, which used to be very cumbersome and all paper, is now digital. There's been meaningful technological improvement, but those are evolutionary changes. The core business has not changed. Our global markets business has been totally revolutionized, right? That business, the sales trading profession, which was a very, thousands of people on Wall Street paid exceedingly well, no longer exists. It's gone. That's all been automated. Access to that research that they used to call people with every morning, everyone has that access on the internet now. Those people are no longer needed. Those roles have been eliminated. Spreads that were 25 cents a share when I joined are fractions of a penny now. That business has been revolutionized. Our business evolves. And so from my perspective, 10 and 20 years from now, I'll be 73 at that point. We'll see. My sense is the business looks, by and large, a lot then like it looks today.
Yet. We'll see about that. Talking about long-term trends, let's talk about the other side of the market. So founders, how has that trajectory evolved? So when you look at the graph of number of public companies in the US between 1980 and 2020, you see a 50% decline after 1996. It's natural to think that companies are starting to not see the benefit of going public in the US. It also causes you to question the competitiveness of the US stock exchanges in a way. But also, if you look at the picture, it gets more dire when you compare it against the overseas exchanges, where obviously the trends everywhere else appear to be the opposite, like a growing number of publicly listed companies. So what is driving this trend, and why are the US founders not going public?
Well, I think they have more of an option today than they ever have. I will say there's a very healthy private market, which is really great because it creates healthy private companies to become healthy public companies. I will say the U.S. is truly the most liquid and envied market in the world. We have companies from across the globe looking at a primary listing in the U.S. because of the investment opportunity. It is a shame, of course, that there are U.S. local companies that are having a harder time wanting to go public. Where we see it is it shouldn't cost $10 million or $115 million to just be public, right? That's on top of your business costs, on top of your required customer and employee costs. Being public should not be a headache. It should not be an abnormal and exorbitant cost. We just saw a company last week, a New York Stock Exchange listed company, Orange Telecoms. They voluntarily delisted, maintaining their listing on Euronext because not only was it not necessary for them here in the U.S., but it was just too much of everything. And so I do think as a founder or as a company that has a strong private equity background, you can stay private for a lot longer to avoid some of these headaches, which again, why there is such a need to reevaluate the landscape of exchanges and make it a place for people to want to be a destination versus a required exit.
Understand. So we've heard some interesting views on both ends. And Nicole pointed out to the complexities within investing. The question I want the audience to kind of answer for themselves, you don't need to give us an answer, but should investing really be the same as ordering an Uber? Just think about it. And while you're thinking about that, I also want to do another show of hands poll. So how many of you actually use mobile banking apps and try to use that more often than going to the branch? Raise of hands. That's very refreshing. Thank you, guys. I want to take that one more step further on robo-advisory. So, Alan, the debate is ongoing, whether the future is digital or physical or phygital. You've clearly placed your bets on the fully robo model, right? Whereas some of your peers, Betterment, Vanguard, have chosen to kind of hedge the bets with more hybrid advisory options as well. So what drove that decision and why?
Well, like I said earlier, our clients in particular, again, the millennials and younger, they don't want to talk to a human. And so I think that there's actually not really an ongoing debate, to be honest. I think digital has won because everybody who's launched that really has no assets in that model and has either shuttered it. And so I think that the market has spoken there. As a matter of fact, why does a millennial who doesn't want to talk to anyone want to pay more to talk to someone? Because that's an upcharge to have the hybrid person. And so, especially for the investment advice that a robo-advisor gives, which is really a passive strategy of indexing, that's not complicated. You don't need to talk to someone to understand that, which is why I think we have better retention of our customers as well as very low support costs, because we're not trying to talk someone onto the ledge to give them an active stock pick, so we never have to talk them off the ledge.
So you see that as a winning strategy already. By the way, on the same note, let's do another show of hands poll. How many of you have actually tried a robo-advisor? Well, that's a data point. So I think that's another thing that I want the audience to take back. Just go and explore. Take a look at that. Scott, private wealth has always been a high-touch industry. And as much as Alan has declared self-proclaimed victory, I am not fully on board with that view yet. Like, there is definitely merit in being able to talk to someone in the world of AI, particularly where models hallucinate, and the way there is a lot of prone to error things with technology, right? So the factor, can you translate trust to technology the way you do with a human? So how have you seen the industry evolve on that regard? And what is the transition point where you think people will want to speak with an advisor?
Well, one, I would largely agree. I mean, I think it's irrefutable that digital has more or less won, fundamentally. Now, there may be digital delivery mechanisms through traditional financial services firms, right? But I founded a bank, and we manage billions of dollars from one branch location. And that's all we'll ever have, right? We've had to move to have more people in that one location, but it's still one location. And I was chairman of that bank until I had to resign to come back to Goldman Sachs. So I think the fewer locations, more app-based or other automated applications, like that's going to happen. That is happening. It's going to continue to happen. That's Superman trying to stop the train. There's no stopping that at this point, and you shouldn't want to. What the traditional financial services firms will do is adapt and deliver and address their clients that way also, right? Goldman invests billions in that delivery mechanism. That'll continue. And then the business continues to evolve. It really was largely active management of equities when I joined it 25 years ago. Today, far more of our assets are invested in passive strategies than they are active strategies today. And another meaningful evolution is, speaking of banking services, Goldman has added banking services that didn't exist when I joined the firm. And initially it was bespoke. Well, you're going to buy an aircraft, we can do that. You're going to add to an art collection or a wine collection, we can do that. Now it's financing buildings like this one and material major products and projects that really can't happen online. That has to happen in person, physical. There's weeks and months of due diligence for that, right?
So that's a very interesting point that you raised there. A lot of incumbent leaders and wealth managers are bringing in more technology into their offerings. But Alan, is it the same? We talked about this.
We honestly don't think so. Wealthfront was founded, I mean, half the company is software engineers. We have 300 people managing $75 billion. And half of them are software engineers. And I think you have to have software DNA to be able to actually build software that does what it's supposed to do. There's a lot of Me Too products out there, but when you actually study them and see if they deliver on what they say they do, they're not as good. And that would be similar if Wealthfront tried to get into an adjacent industry like if we tried to go give human advice and open branches, we'd be terrible at it because we're mostly engineers. But so people who come from outside of software who try to build great software, I think, don't build it in a way that our clients want to experience it. And if you opened up a Vanguard app or a Charles Schwab app or something that's more legacy and you looked at it compared to what we've built, it's like looking at a Nokia phone versus opening up the iPhone 16.
Such a humble guy. Okay, I think on a more serious note, there are clear advantages of a tech-first strategy, and that's what we wanted to kind of get into the weeds of. One of the factors that allowed you to turn profitable was keeping costs in check. Half your firms are engineers, and we know you got to pay them to keep them. So how do you maintain that cost edge being a tech-first company? And Talk to us about what is the mindset that you've kind of run with to take advantage of the fact that you're tech first.
Yeah, I mean, it's been said a lot here today. We automate as much as we possibly can, right? So I think one stat that usually blows people away is of our over 1 million clients, we only have 20 plus product support reps. So one product support rep is servicing 50,000 clients. Part of that is based on the fact that it's all digital and that the strategy is very basic with passive investing. But again, clients, they mostly can get stuff done self-service on the app. We don't call our client support service, we don't call them client support reps, we call them product specialists. They work with product teams to hear what the client is saying, and then they fix that in the app. So we're constantly iterating to make the experience better so that we don't have to scale our support staff linearly with customers. It's all done sublinearly, which helps us grow and have huge operating leverage where every additional dollar just follows to the bottom line. So to get another 75 billion, we don't need to hire another 300 people. It doesn't scale like that.
That's a very tricky question. I'll come back to you on that. But before that, Scott, how are you leveraging technology in Goldman Sachs? Like, what are some of the clear benefits that you've adopted technology that has kind of brought on operational efficiencies for you?
You bet. So it's our biggest expense line item also, as you would imagine. It kind of goes through this big budgeting process every single year, which is, by the way, we're entering into right now. And what it's done is it's improved the client experience by streamlining a lot of things. And then it's really freed up our advisors and their support teams to spend more time with their clients, which again is our core business, right? That's the high touch model. The average account size, just to put it in perspective, at Goldman Sachs is $67 million. And so it is a high touch model. The more time we can free up for advisors to spend time with their clients and provide better advice, the more we improve the client's experience and the business for Goldman. And so that's where it's been for us. It's been automate as much as possible. By the way, that's helpful from a compliance standpoint because you have consistency as well. And exception reporting, and those are the investments we're making.
So, and you brought in a lot of the intelligence that your advisors or your relationship managers actually had onto the tab, which is also very good for business because you can manage attrition, which is one of the key challenges, I guess, with private wealth managers, right?
That is correct, and that's also a significant investment, as you'd imagine.
So, to your point, Alan, about this is a very controversial thing to say. You have one customer rep taking on 50,000?
50. They're not taking them on. I mean, that's just that's the way the numbers work. Like, we don't assign them. It's just there's 1 million clients and there's about 20 support reps.
Yeah. So that is still that ratio, right? Like, that's how you kind of look at customer support. And you don't use NLP for your chatbots.
No.
So speak to us, and I think that's really profound because I've realized there is this inherent need. Everything needs to be ML, everything needs to be AI, and here we have a 99% SLA with customer support without the use of NLP. Please talk to us about it.
No, I think the first panel talked about it a lot, right? You got to listen to your customers, and so if we listen to what our customers say and fix it in the product, then we stop getting those contacts, whether they're through mail, email, or phone calls. So it's really as simple as just getting your customers involved and really listening to them. You don't need to adopt AI just to get that done. We've been able to become extremely efficient without doing these natural language processing models you're talking about, just by merely figuring out what are the most tickets we're getting, assigning an engineering team to fix that, and then moving on to the next thing.
So plain old automation.
Yeah.
Nicole, how are you guys leveraging technology?
Well, technology, of course, is the core to our exchange being completely electronic. I think, Scott said it so well in just our generation, at least most generations in this room. The trading landscape has changed tremendously. And I'm thrilled that at the Texas Stock Exchange, both Jim Lee and Cam Smith, so Jim, our CEO, and Cam Smith, our co-president, were really the pioneers, to move from, human-based trading and required of all of the kind of manual pieces to it to electronic trading. So, we have the band back together. And on top of that, we have a fantastic ensemble of amazing veterans in the market technology space. So we will be incredibly competitive. And I think as we continue to build this, the next question is how can we make it even more incentivized and offer something that's unique to create on-market trading and bring back that type of volume to the market.
Wow, that's something to look forward to, guys. I think we're very close to time, but the key part of our panel is still pending, which is what does the future investor want? And I know a lot of clients put in requests to talk about, Scott, I'm going to pick on you on that, and that's right up your alley. What are some of the asset classes that you expect to do well in the next 3, 6, 12 months? And I was asked the question 10 years down the line.
So I'll say on the shorter time horizons, really for the last couple of years, kind of everyone's best idea has been private credit. Your natural reaction should be when everyone has the same best idea to be worried, by the way. But nonetheless, for that kind of time horizon, you probably live with that 3, 6, 9, 12 months of those. And then for 10 years we're staring at flashing zeros here. For 10 years or longer, debt's equities. You don't have to make it more complicated than that. It's probably largely passive, as you described. I think I'd do it on a tax-advantaged basis if you're a U.S. taxpayer. And then it's probably U.S. equities.